Hi, my name is Farid Ilishkin. I'm partner at PwC Central and Eastern Europe, and I'm Russia Deals and Valuations Leader there. Today I will tell you about practical application of capital structure theory. First, capital structure, practice versus theory. Does the choice of capital structure affect the value of the firm? In a perfect market, the value of the firm does not depend on its capital structure. But we don't live in a perfect world, unfortunately, and therefore the choice of capital structure does affect the intrinsic value of the firm. We have taxes, and we know from Benjamin Franklin that in this world nothing is certain but death and taxes. And interest on debt reduces taxes. Also, interest on debt as well as debt repayment decrease cash flows of the firm and forces management to be more efficient. How they say, to run the tight ship. So these two factors increase the value of the firm. But the higher the share of debt, the higher the cost of financial distress. And this third factor decreases the value of the firm. So if in practice capital structure affect the value, then why do we see some companies with zero debt? And some of them even they have huge cash balances. So effectively they have negative financial leverage. Reasons could be different, and optimal capital structure varies in different industry and depends on company's stage of life cycle. For example, internet, software, biotechnology companies, they have no or very little debt. And in contrast, real estate development companies, utility companies, private medical centers, they have high debt ratios. For example, startup biotechnology firm. This firm can have a great potential but does not have taxable income this year. So the tax shield does not work as you have nothing to shield. For this company, optimal capital structure does not include debt, only equity. But it is a completely different story for profitable firms with high and stable cash flows, which have low or zero debt ratios. These companies, they have considerable borrowing capacity, and if they finance their needs through internally generated funds, they just don't reap the benefit of debt. Let's look at the example of a large, mature company operating in a mature industry. The company's profile. It is a large producer of consumer goods. It is a mature company and it is operating in a mature industry. Sales in the industry are not cyclical. For the last 3 years, the industry showed a growth of 3 to 5%. Competition is moderate, and the company is one of the industry leaders with 10% share in the market. Capital expenditures are expected to be modest, as the company is not committed to large investment projects or acquisitions. The company has 10,000 shares outstanding. The share price is $25, and that gives market capitalization $250,000. Let's look at the balance sheet. And here you see huge cash balances of $60,000, zero debt. Look at income statement. Here you see interest income, $3,000. It's income on excess cash, and zero interest expense because obviously you don't have debt on your books. And this is the comparison with peer companies. The company has the solid 28% EBITDA margin, comparing to a median of 90% across the peers universe. And the same difference is with the net income margin, 22% comparing to 10%. Median debt to capital ratio of the peer group is 54, and median net debt to capital ratio is 43. So we see that our company has a lot of room for leverage with its zero debt and huge cash on books. So zero debt and huge cash result in negative net debt to capital ratio for our company. The company has the lowest return on equity. It's 15% against the median 22% across the peer universe. And it is despite the fact that the net income margin for our company is much higher. And this is a consequence of under-leverage comparing to peers. The company is one of the industry leaders with highest margin. Therefore, it has higher EV/EBITDA and price earnings multiples than the peer group. So we looked at the profile of the company, we compared the financial ratios with the peer group. Now it's time to trade-off theory, and here I will show you the framework for practical application of trade-off analysis for this mature company. Okay, value of levered firm is the sum of present value of unlevered firm, present value of interest tax shield, present value of incentive benefits of debt, and minus present value of costs of financial distress. So as the debt level increases, the firm benefits from the tax shield and improved incentives for management. However, if the debt level is too large, firm value is reduced due to the costs of financial distress. Let's start the analysis with tax benefits of debt. So which type of firms would you expect to have particularly higher tax benefits? And the first type of this firm is firms with higher profits. So if profits are high, that means that more taxes are paid. That means that interest can shield more income from taxes, and that gives us higher tax benefits. With our company, it has high EBITDA and EBIT margins, therefore more taxes are paid, and that gives us higher tax shield and higher tax benefit. The second type is the firm with less volatile profits. So if profits are less volatile, that means that there is a lower probability that profits are less than interest payments. And for our company is a mature firm. That means that we have lower volatility of profits and therefore higher tax benefits. We are the large firm within the industry, so that means that we have more economy of scale, and that means lower operational leverage, lower volatility of profits, and again, higher tax benefits. Our industry is not cyclical, so again, that means that we have lower volatility of profits and higher tax benefits. So our conclusion is that tax benefits of debt are high. The next, incentive benefits of debt. You know that managers make wasteful spendings when firms have cash flow in excess of what is needed. When cash is tight, managers have to run the firm as efficiently as possible. Firms with debts have to make interest payments and have to repay these debts. So that repayments reduce excess cash flows, and that means that it reduces wasteful spendings by managers, and that gives increasing firm value. So which firms are likely to have high incentive benefits of debt? It's mature, moderate growth, cash-rich companies or industries. And for our company, we have high EBITDA and net income margin. That means that managers can make wasteful spendings, and therefore we have high incentive benefits of debt. So our firm has small investment needs. It is a mature company, and therefore we have higher cash flows, and managers can make wasteful spendings. Again, that gives high incentive benefits of debt. Another type of the firm is larger firm within the industry. So again, larger firm, more economy of scale, that gives lower operational leverage and lower volatility of profits. With that, we have relaxed management who can make wasteful spendings, and that gives us high incentive benefits of debt. So our conclusion for this company is that it has high incentive benefits of debt. The next, expected costs of financial distress. And if we talk about expected costs, we have to take into account probability of financial distress and cost if the company is in distress. Let's start with probability of financial distress and which firms are likely to have high probability. It's firms with high competition risk, firms in unproven markets with high demand volatility, it's startup companies with unproven business model, it's firms in technology sector with high research and development dependence, and it's firm with large cyclical or seasonal variations, and smaller firms without diversity across businesses and products. And we see that none of the above applies to the company. Our company is large in non-cyclical industry. It is mature business with proven business model, one of the leaders in the industry. So our conclusion, probability of financial distress is low. Which firms are likely to have high costs of financial distress? The first type is firms with valuable relationships with customers, suppliers, and employees. For example, durable goods producers. If the car manufacturer is in financial distress, customers are less willingly to buy its automobiles because they don't want to face with the situation that they bought the automobile and there is no service after the distress of the company. So that leads to revenues, to decreased revenues. And suppliers of this kind of automobile producers, they demand prepayments. They don't want to deal with the company in a financial distress. And that leads to cash deficits. Another example, human capital intensive companies. For example, a bank in a financial distress. Employees of this bank leave as they want to work in a stable bank. And bank has to pay higher salaries to return these types of employees. The second type of the firm is a firm in highly competitive environment. So this firm have to preserve high margin in order to service debts, to pay interest on debt, to repay debt itself. So if competitors cut prices, they cannot respond. And with higher prices, they cannot decrease their prices as well. And with higher prices, the firm loses the market share and eventually the revenue. And another type is smaller firms, and because many aspects of the bankruptcy process are independent of the size of the firm, the costs are typically higher in percentage terms for smaller companies. Another type, firms with difficulties to sell assets in distress. It's like research and development intensive industries with intangible assets, because it's easier to sell office or a car rather than intangible assets. The second is specific or highly specialized asset, and this asset has only few potential buyers, like highly specialized metal press. And with few potential buyers, we have to provide higher discounts for fire sale. And it's cyclical industries. When a firm in distress due to some downturn in the economy, other companies in this industry are also in distress. And for example, airline. The economy goes down, the particular company is in distress, it wants to sell airplanes, but all the potential buyers are also experience difficulties and they don't want to buy these planes. And the last type, firms with high investment needs. It's capital intensive firms or firms with high marketing expenditures. So underinvestment is costly. And if you don't have cash for capital expenditures, you would not be able to expand as you planned, and you will lose your market share. So again, if we look at our company, none of the above applies to it. That means that costs of financial distress are low. And with low probability of financial distress, the expected costs of financial distress are also low. So, conclusions. With high benefits of debt, high incentive benefits, high tax benefits of debt, high incentive benefits of debt, low probability of financial distress, and low cost of financial distress, the company should increase its leverage. And we also see that median debt to capital ratio for peers is 54. And the company has a lot of room with its leverage of 0. And we also see that the company is one of the leaders with highest margins. It's like 28% EBITDA versus median of 17% across the peer universe. So the company can have even higher leverage than peer companies. Our company is over liquid, it has excess cash, and under levered, it has 0 debt. So its shareholders are paying price for that. And in order to unlock value inherent to the company, we can use cash on its balance sheet and borrow money to buy back its shares. So leverage recapitalization. So we can take a look on the balance sheet. So how we should execute this leveraged recapitalization? First of all, look at the assets. We spent 60,000 of cash for repurchasing shares. Look at the liability side of the balance sheet. And on top of this 60,000 cash, we take a loan on 60,000, and this 120,000 we use it for repurchasing the shares. And you see that equity is decreased by 120,000 and debt increased by 60,000. Income statement. So we remove interest on excess cash and we add interest on debt. Okay, we did this recapitalization, so how shareholders should reap their benefit. And here we have the theoretical concept of value of the interest tax shield. You all know this. These are the formulas. And for the case when we assume constant debt level, these are the formulas. Very easy. It is interest divided by cost of debt. This is the debt, and times income tax rate. That gives present value of tax shield. Let's look at the calculation. We have interest deduction, interest expense. It's 6,000 times 20% of income tax rate, and that gives us tax savings. Interest tax shield of 1,200, and we capitalize it at the cost of debt of 10%, and that gives us 12,000. And the second method, we call it a simple back of the envelope calculation. It is debt 60,000 multiplied by 20%, and again it gives the same result. Let's look at the effect on market capitalization. We know that market cap is 250,000. We add 12,000. That gives about 5% increase in market cap. Not very impressive, but let's look at the next slide. You know that holding excess cash inside the firm creates an anti-tax shield. And this anti-tax shield is the mirror image of the tax shield created by positive debt. So since cash is negative debt, the same trade-off analysis holds. So debt has tax benefits and cash has tax costs. So adding $1 of excess cash to the balance sheet increases value not by $1, but by 80 cents, as you pay 20 cents as taxes. The value lost is 20 cents, and therefore this is the present value of anti-tax shield. Again, cash has incentive costs. Debt had incentive benefits, and cash has incentive costs. Cash can be wasted on perks, on bad acquisitions. So if management have cash, they are relaxed and they make wasteful spendings. And again, if debt increased expected cost of financial distress, cash has benefit of reducing expected costs of financial distress. So as trade-off analysis have this kind of anti-tax shield, it should consider not only debt, but cash as well. And here is you can see the complete calculation of the value of interest tax shield. And on top of the left side of this table, you can see the right side. And here we have interest income on excess cash and interest anti-tax shield. And as we remove this excess cash, we have additionally 12,000 which is added to our total value of tax shield. So the effect on market capitalization is not 5%, but about 10%. And our market cap is 274,000. We looked at the book values. Let's look at the market balance sheets. So initially we had capitalization of 250,000, and this is split between cash, 67,000, and other assets. And we had 10,000 shares outstanding, so the share price is 25. So when you make the announcement, the market participants understand that there will be additional value of interest tax shield. So you add this interest tax shield to market cap, and that gives you 274,000 or share price of 27.4. The next step, you issue the debt. You increase your assets and you increase your equity and liabilities, but the share price is the same, 27.4. And the final step, share repurchase, you decrease cash by 120,000. So you see that you had 127, now you have only 7. And you increase your and you decrease your equity by the same number. So the repurchase share price is 27.4. The amount spent on repurchase is 120,000, and that gives the number of shares which you have repurchased, 4,380. And the remaining shares are 5,620, and the share price after purchase is the same, 27.4. Let's look at the effect of repurchase on financial ratios. So earnings per share and dividend per share showed accretion about 20%. But share price increased about 10%. It has lower than EPS or DPS rise because the risks for shareholders increased with higher leverage. Debt to capital ratio now is 67, a bit higher than median for peers of 54. But market debt to capital is 28%, which is a bit lower than the peers' median of 34%. And the reason for the difference is that it is that our company has higher market multiples than peer group. So EV/EBITDA for our company is 6.5, and median for peer group is slightly less than 6. Return on equity increased significantly, you see, from 15 to 51. And that was because historical book value of equities adjusted by the repurchased shares at market price. And market price is higher than book value. And you can see that book value of shares was 150, and that gives $15 per share versus $27.4 per share for repurchase price. So book value of equity decreased by 80%, and market cap decreased by 48%. So shareholders who tender their shares and their shareholders who hold their shares, they both gain $2.4 per share, or about 10%, as a result of this repurchase. So in previous example, we had a company with stable cash flows and modest capex requirements, but let's consider an opposite case. The company's profile. The company is a smaller and younger company comparing to competition. It has strong sales growth, but there is a high uncertainty with the future cash flows. It is a capital-intensive business. A high level of capital expenditures is required to support the growth. So you need more than $1 of capex to generate $1 of revenue. Internally generated funds are not sufficient to support the growth, so you need external financing. Let's look at the income statement and the forecast for the next 3 years. And you see that revenue will grow 5 times, from 1,000 to 5,000. You see the strong EBIT margin of 18%. Let's look at the balance sheet. And in case you have no external finance, you see that you have cash deficit, and negative cash assumption is not realistic. And here you also can see that you have no external finance because you don't have any changes in long-term debt and any changes in equity. This is the cash flow statement, the forecast. And again, no change in long-term debt and common stock. And this is the uses of funds part. And you see that sources of funds are much less than uses of funds because they have huge investments. Investments in fixed capital, fixed assets is very high. And again, negative cash assumption is not realistic. In this part, we apply trade-off theory, our framework for this high growth and capital-intensive company. Again, we start with tax benefits of debt. So the company has some uncertainty of the future profits. That means that the firm's cash flow may be volatile. That means tax shields will be riskier, and therefore we have less tax benefits. It's a younger firm comparing to competitors, therefore it will have volatile profits. Again, that gives less tax benefits. It is a smaller firm within the industry that gives us less economy of scale, high operational leverage, and again, that results in volatile profits and less tax benefits. High capital expenditures, that means that we will have substantial depreciable assets, and that gives less tax benefits. And I will stop here and explain you So if you have EBIT and you have high level of fixed assets, that means that you will have high depreciation. High depreciation will decrease EBIT and decrease operating profit and therefore decrease taxes. So conclusion is the following: tax benefits of debt are low. Incentive benefits of debt. So the company has high investment needs. That gives us less cash flows available and therefore more disciplined management and lower incentive benefits. It is smaller firm within the industry, therefore it has less economy of scale, lower and volatile profits, and again lower incentive benefits. So our conclusion: tax benefits of debt are low. Expected costs of financial distress, and again we start with probability of financial distress. So uncertainty in future profits, the firm's cash flows may be volatile. That gives us higher probability of financial distress. It is smaller firm within the industry, again that results in higher probability of financial distress. It has high competition risk, that means threat from existing larger competitors who may decide to cut prices to preserve their market. That gives us higher probability of financial distress. So conclusion: probability of financial distress is high. Cost of financial distress. The firm has high investment needs. That gives us higher costs of financial distress. Smaller firm, again higher costs of financial distress, and higher competition risks results in again higher costs of financial distress. So with high probability of financial distress and high costs of financial distress, we have high expected costs of financial distress. And our conclusions: with low probability of debt, low incentive benefits of debt, high expected costs of financial distress, the company should decrease its leverage. Analysis of financial alternatives, base case. So, making decisions on capital structure should never be considered as a standalone exercise. Capital structure decisions should be reconciled with a company's strategy. So the following step-by-step analysis should be undertaken for the financial policy formulation. And the first step is estimation of future funding requirements. And we have done it in the table above, in cash flow statement forecast, in income statement forecast, and in balance sheet forecast. The second step, trade-off analysis of the target capital structure, and we have also done it, see above. And the final step is analysis of financial alternatives. So let's look at the base case if we take debt. So we see that there is no change in common stock, and we increased our long-term debt. That will result in positive cash at the end of periods. So now we don't have cash deficits. We see again here there is no change in common stock and increase in long-term debt. And interest expenses increase comparing to the case where there were no external finance. Debt to capital ratio increases, but it is still not critical. So we had 64, now we'll have 70 at the end of year 3. Interest coverage ratio is still higher than a threshold of 2. Current share price is 20, and if we multiply it by number of shares outstanding, it would give us market cap of 2,000. We add net debt, and that will result in EV, enterprise value. And if we divide this EV by the EBITDA of the company, actual EBITDA, that will give us 10.4, and we call it implied EV/EBITDA multiple. And it is pretty high as the company has high growth perspectives. In further years, EV/EBITDA decreases a bit as the company becomes more mature. And future share prices were calculated based on these EV/EBITDA multiples and forecasted net debt. So by the year 3, we will have the share price of 65, comparing to 20, the share price of as of now. That gives us strong, more than 3 times growth. And again, as we issue no new shares, there is no dilution for current shareholders. So that was the scenario when we issued debt. Now we look at the scenario for common stock. And you see that there is no change in long-term debt, and we are issuing new common stock. In this case, interest expense are not increasing comparing with the scenario where we had no external finance. Debt to capital ratio significantly decreased from 64 to 20%. Interest coverage ratio is way higher than a threshold of 2. Share price increased from 20 to 52. It is a bit less than 65 in debt scenario. And current shareholders are diluted down to 57% because we had 100 shares, and by the year 3 we'll have 174 shares. The next scenario, it is when we take not just debt or just equity. We increase debt by the half of the amount in the debt scenario, and we increase equity by the half of the amount comparing to common stock scenario. We call this scenario 50-50. So interest expense here increase comparing with a scenario where we had no external finance, but lower comparing with debt scenario. Debt to capital ratio decreased, but not as much as in common stock scenario. Interest coverage ratio is higher than the threshold of 2 and is between the debt and common stock scenario. Share price increased to 57.58 and it is between 65 and 52 in debt scenario and common stock scenario. And current shareholders are diluted to down to 74%. And it is better than in common stock scenario, but of course in debt scenario you have no dilution at all. And the final fourth scenario, this is the scenario when we are issuing common stock in year 1, and then we increase long-term debt in year 2, and then we have 50-50 in year 3. So interest expense are the same in year 1 if we compare it with no external finance scenario, and then interest expenses increase with long-term debt growth. Debt to capital ratio decreases to about 40% level in year 1, and then it is not declining as it was in common stock scenario. Interest coverage ratio increases significantly in year 1, and further increase is not as high as in common stock scenario. Share price increased to 55, and it is lower than debt scenario. It is lower than 50-50 scenario, but higher than in common stock scenario. And current shareholders are diluted to 69%. Again, it is better than in common stock scenario, but a bit worse than in 50-50 scenario. So our preliminary conclusions. Trade-off analysis indicated that common stock should be issued. But analysis of alternatives showed that common stock scenario results in the lowest share price in year 3 and the highest ownership dilution for existing shareholders. If we look at that scenario, it has the highest share price in year 3, no dilution of ownership for existing shareholders. EBIT interest or interest coverage ratio is still higher than 2 threshold. Therefore, the company does not violate covenants associated with the bank loans. And other 2 scenarios are in between of debt and common stock scenario. And with 50-50 scenarios looking more attractive from the share price and stockholders dilution perspective. So the bottom line, it seems that 50-50 scenario looks like reasonable from the share price and risk perspectives. But we know that there is high uncertainty associated with sales growth of 5 times. And a target capital structure should take into account uncertainty and the possibility of decline in profitability. In these circumstances, a worst case forecast of cash flows usually supplements the base case. Analysis of alternatives, worst case. So the worst case and the debt scenario. We see that in this case revenue is 20% lower than in base case. Operating margin is 5 percentage points lower than in base case. It is 13% comparing to 18%. And now we have cash deficit due to the low revenue and low profit forecast. Debt to capital increases significantly. Now it's from 64 comes to 80%. And interest coverage ratio is lower than a threshold of 2. So we have violation of covenants associated with the bank loans, and that may trigger bankruptcy. And we know that in times of distress, raising funds to cover cash deficit is difficult and expensive. And in distress, valuation multiples are also lower than in normal times. And you can compare the forecast EV/EBITDA with the forecast in base case. That gives, together with a lower forecast of cash flows, lower EV/EBITDA forecast, gives us share price decrease from 20 to 16. And it is comparing with 65 in base case scenario of debt. Okay, even in that base case analysis, we said that debt scenario is not a preferable scenario for this company. But we said that 50-50 scenario is the best one for that. Let's look at it. Here we have cash deficit due to lower revenue and profit forecast. And here we see that again, in year 1, interest coverage ratio is lower than the threshold of 2. And again, here we have violation of covenants associated with the bank loans, and this may trigger bankruptcy. And again, in times of financial distress, raising funds to cover cash deficit is difficult and expensive. So debt is a two-edged sword. It permits the company to grow fast and creates tax shields, but it exacerbates problems at the period of downturn. The company's growth strategy is dependent on huge capital expenditures program. And to fund its strategy, the company needs assured access to external financing. And with interest coverage ratio of 1.3 in debt scenario and 1.6 in 50-50 scenario in year 1, that may trigger default. And in this case, forecasts for year 2 and 3 may become meaningless. So this forecast may be meaningless. Inability to raise external funds would make impossible to attain the revenue growth in year 2 and year 3. So realistically, in these circumstances, revenue in year 3 will be much less than 4,000, let alone 5,000 in base case. And in addition, weakness of the company's financial position may encourage aggressive attacks from larger and financially stable competitors, and inability to match competitors' price cut will further decrease the revenue forecast. So, okay, now we see that 50-50 scenario is bad for the company. Let's look at common stock scenario. And here again we see the cash deficit, and debt to capital ratio significantly decreases from 64 to 22%. But if we complete the calculation and forecast higher equity injections in order to cover cash deficit, the ratio would be even lower. So interest coverage ratio is higher than a threshold of 2, so no violation of covenants associated with the bank loans. And in this case, raising funds to cover cash deficit is easier. Share price decreased to 18 and comparing to 52 in base case of common stock scenario. And current shareholders are diluted down to 43% versus 58% in base case of common stock scenario. If we complete calculation and forecast higher equity injections, the dilution would be even stronger. And the fourth scenario, when we issue common stock, then debt, and then 50-50. Again, we see a cash deficit. We see that debt to capital ratio decreases significantly in year 1, and then it is around the healthy level of 50%. EBIT to interest coverage ratio is higher than a threshold, so there is no violation of covenants associated with the bank loans. And again, in these circumstances, raising funds to cover cash deficit is easier. In this scenario, we have decrease of share price to 18, comparing to 16 in worst case of debt scenario. And current shareholders are diluted down to 61%. But again, if we complete calculations and forecast higher equity injections, the dilution would be even stronger. Okay, if we say that we need to complete calculations, and if we see that the fourth scenario may be more preferable, let's finalize our calculations. So now we have higher debt and equity injections comparing to base case. And due to that, we do not have cash deficit now in the forecast. Debt to capital ratio decreases again in year 1, and then is around healthy level of 50%. Interest coverage ratio is higher than the threshold of 2, and share price decreased to 18, and shareholders are diluted down to 61%. So conclusions. If we analyze only base case and choose 50-50 scenario, we may end up with violating bank covenants on interest coverage ratio. And as a result, the company would not be able to raise the capital needed to finance its capital expenditure program. And that will result in collapse of its growth prospects. So the capital structure policy determines the degree of access to external funds. And the analysis of worst case makes it clear that issuing common stock is the right decision at the beginning of year 1. That will decrease debt to capital significantly from 64% to 42% in year 1, and with interest coverage ratio higher than 2, it will not lead the company to default on its loans. And in year 2, having the lower debt to capital ratio and interest coverage ratio higher than 2, the company may choose between common stock scenario and common stock, then debt, and then 50-50 scenario. And the second one seems preferable as it gives healthy debt to capital ratios, good interest coverage ratio, and lower dilution of existing stockholders' share. This is our conclusion from the practical example.